Hey everyone, welcome to this week's webinar. Today we're going to be talking about the 2026 Important Numbers Guide that I had sent out a few weeks ago. I figured, maybe you guys don't know all of the different numbers that are in there and what everything means. So I thought it'd be helpful to just walk through some of the areas in that guide that I know are going to be important for court reporters to make sure they have a good understanding of as they look at their financial planning for 2026. So I basically just took some screenshots of different pieces of that guide. And so today we'll just go through some of those different pieces and talk about how they fit into your financial planning. And of course, if you guys have any questions along the way, definitely feel free to leave them in the comments. So diving into the first piece of the guide, I wanted to start with income taxes. Now, for some of you, this could be very, very simple or something you're very familiar with. And for others, maybe you really have never actually thought about like how tax brackets work. So I thought this would be a good starting point, and then we can go further and a little bit deeper from there. So what we're looking at is we have the federal income tax rates listed here on the left. So starting from 10% and then going all the way up to 37% for 2026. And then we have married filing jointly, single folks, and then we have estates and trusts. So we're really just going to focus today on the married filing jointly or single individuals. But what I really want to talk about is just conceptually, how does this actually work? So a lot of people think that based on what the income is that they earn, what their taxable income number is, that's basically what their tax rate's going to be. So for example, if you are married and your household brought in $200,000 of taxable income, then you're going to look at this bracket and say, okay, 200,000 comes in here in this bracket. And so that means that I owe 22% on my $200,000 of income. So my taxes is going to be 44 grand. That's actually not how it works. And it works in a more favorable environment than that, which is great. And so the way that it works is that you actually fill the bucket. So think about filling the bucket before you move to the next bucket. And that bucket you fill pays the rate that it's tied to. So for example, you would actually pay 10% on the first 24, I'll just call it $25,000 that your household brings in. So that first 25 grand gets charged 10%. The next 25 to 100, so you could say your next $75,000 that you make, that money gets charged 12% tax rate. And so that keeps going up. And then if you were using my example of 200,000, that means that from 100, really closer to 101 up to the 200,000 mark that I mentioned as just an example of a household income, that would be taxed at the 22% rate. So when you then add up the taxes that you had to pay for each of these different brackets along the way, you are no longer going to be looking at a 22% rate, but you could be looking at closer to like a 13% or 15% tax rate, somewhere in that range. And that is going to be the actual tax rate that you pay your taxes on. So a lot of people like to say like your marginal tax bracket. The marginal is just the highest tax bracket that your income reached versus being your effective tax rate, which is what you actually paid, what the percentage was for your income. So just an important piece to clarify on. And one thing that someone had mentioned in another Facebook group that I'm in is they were asking about what tax savings do you actually get from contributing to an account like a pre-tax IRA? Well, a good way to look at that is by actually focusing now on your marginal bracket, so the highest one, because that's where you're going to be saving on taxes. So as an example here, we'll stick with my 200,000 number. If your household brought in $200,000, but you contributed $10,000 toward a retirement account this year, well, that's 10,000 less in this largest bracket specifically. So that 10,000 is not paying the 22% anymore. So the amount of money that you save in taxes by contributing to your IRA is going to be your highest tax rate, and you deduct that from the income that you would have had to pay taxes on. So marginal rates have a place when we're looking at benefits for contributing to things like retirement accounts, but then effective tax rates is usually using each of the different buckets to figure out what you're actually going to owe after that time period. So moving on from there, we also have capital gains tax rates. So if you're investing in an account that's not a retirement specific account, then we have short-term capital gains and long-term capital gains. And the break-even point there is 1 year of holding the funds. So if you hold the money in the account for, or sorry, if you hold the investment specifically for 1 year before you sell, then you would get long-term capital gains rates. If you invest in, you buy a stock and you sell the stock next week, anything under a year, then you're going to pay short-term capital gains rates. Short-term capital gains rates are normal income taxes. So refer back to the last slide I just went through. That's what you would pay on the gains that you had in your investments. Anything that's over a year, that's the long-term capital gains tax rates. Then we move into a new bracket that you can see here, which actually is pretty nice, where it starts at 0%, goes up to 15, and then up to 20%. Now, most of the time when you talk with someone and they're talking about your long-term capital gains rates, they'll just tell you 15%. The reason why is because most people that we're working with are going to fall into this bucket because it's a really big bracket. So it goes from 99,000 for married filing jointly, $99,000 of taxable income, all the way up to 613,000. So it's a huge window where you're going to be paying a 15% rate. Now, another important piece is this does also work like the income tax brackets, where let's say that you only made $80,000 and you're married filing jointly, so your household brought in 80 grand. But let's say you had a huge gain that you sold from your investments and you had $40,000 of investment gains. So the way that that would work is actually from the 80 up to the 98,900 is 0% taxes. So you don't owe any taxes on that. You would only owe taxes on the gains in your investments now from that point and above. So considering we made $80,000 and you had $40,000 of gains, that's put you at 120,000 total. So even though you're at this 120,000 mark and you had $40,000 of gains, you're actually only paying the 15% rate on, we'll call it the 21 grand above this number here. So that is a nice piece to consider, is that it is a marginal tax rates as far as how that works. But most of the time, the people that we're talking with about their financial planning, they're usually over 100,000. And a lot of them, especially like court reporters, are usually going to be somewhere in this, 99 to $600,000 range. And so they're going to be paying the 15% rate. The other piece to note here, though, is that on the state side, every state is different. So you need to look at your specific state to see if there are better tax rates for holding for over a year. I'm in California, so I just know that one off the top of my head. California does not have short-term capital gains taxes and long-term. It's all the same. So all the gains that you get in your investments in California all pay income tax rates. So it's just straightforward income taxes. There's no difference for holding it for a longer period of time. Now, one thing that can be a little bit of an add-on, a little bit of kicker on top of your 15% rate is a net investment income tax. So this is just like a caveat to the numbers that you see here, where if you have your income is over 250,000 as married filing jointly or 200,000 single, you have to add an extra 3.8% on top of your 15% rate. So it's a little bit weird, but basically, if you're over that threshold, just add another 4% on top of this tax rate that you now have to pay. So these are important numbers as you think about your financial planning for this year. If you're planning, say, to buy a house and you're going to have to sell a lot of investments, you're going to have a lot of gains this year. It may be important to try and do everything you can to stay under this 250,000 or $200,000 number. Maybe you need to do more contributions to retirement to get under that number, and now you're not going to have to pay that 4% on your investment gains anymore. So hopefully we can save a little bit there. So moving on to this next slide here is going to be talking about the child tax credit. Not too much to talk about here. It was kind of just a weird piece in the guide, so it was easier just to do a one screenshot of this one. But we have the child tax credit, which is not a deduction. So you're not lowering your income tax, or sorry, you're not lowering your income and then that's helping you save on taxes. You're actually directly lowering your tax bill. So let's say you do all the calculations with your CPA and you owe $10,000 in taxes this year. Well, now with your child tax credit, you would go down to 2,200 off of that. So now you would be at $7,800 of taxes owed. So it directly lowers your tax bill. So that's really, really nice. A tax credit is much better than a tax deduction. There are phase outs for this as well. They are decently high, so keep that in mind, but it's definitely still possible to be above these. And then there's like a refundable amount, which means like if your taxes were zero and this puts you at even, negative, they would give you money back. But I don't really think that's going to be relative to anyone in this group. So really, I would just think about this $2,200 number is going to be the most important one. Also, there's another benefit, a credit that you can get for child independent care. And there's some more rules about this one, so maybe I would consult with a CPA as far as how that one operates. Next, I want to get into really all of the deductions that you get to take from filing your taxes. So we have the standard deduction being 32,000 and 16,000 for married and single filers. And then you also can get an additional deduction if you're married for each eligible spouse, and then also for unmarried folks as well, if they have an age 65 or older spouse in there, or you do have a blind spouse. So very random. I don't know why it's specifically if you're blind, but I guess they'll take it. So if anyone does, fit that or is married to someone in one of these two categories, you do get an extra deduction off your taxes, which is nice. And then when we go to look at itemizing, which more people are going to be doing this year than they have in the past, one of the biggest changes is actually the SALT deduction, so state and local tax deduction. And this is where the bulk of your deductions come from when you're trying to decide if you're going to take the standard deduction or if you're going to itemize. You need to basically add up what it would look like if you itemized and see which one's going to be a better deal. Well, for this year, in the next few years, I think only maybe like the next 4 years, you can get a SALT deduction up to 40 grand, and that used to be 10,000. And so what qualifies for this would be your California or like your state income taxes would count toward this, your property taxes. So it can be pretty easy to get this number relatively high up, where most of the time for us Californians, you would hit 10,000 no problem, and you would have way more in California state income taxes and property taxes that you basically could not get a deduction on. So now the fact that you can get up to 40,000 for this number, it's so much higher that it's going to make it a lot easier to itemize instead of taking the standard deduction. So hopefully for a lot of you in 2025, as you're filing your taxes in 2026, you'll be able to start benefiting from this, and you'll be able to itemize this year if you weren't already. Now, there is a phase out range for this one as well. Everything in taxes has a phase out range, but it is pretty high. So I wouldn't be too worried about that. Either 505 or 605,000 that you have to hit to get that. And then below here, we have a bunch of, some of them are new, non-itemized below the line deductions. So what that means is that you can get this deduction even if you take the standard deduction. You don't have to itemize to benefit from these. And so I'm not going to go through each one just for the sake of time, but you can always refer to this or refer to the guide to see if you might qualify and talk about it in more detail with your CPA. The only one I do want to point out is the one here at the bottom, which is the QBI deduction. And that I did a whole webinar on. So if you do want to learn more about the QBI deduction and how you can benefit from that and what that looks like, go into the guides on my Facebook group And in the guides, there's one that has the video for the QBI deduction, and you can watch that one. Lastly, here, and really most importantly, is going to be the retirement planning one. So the contribution limits, we have 24,500 for this year. You get a catch-up contribution if you're doing like this is really for like a solo 401k. You can do another 8,000 if you're over 50. If you're between 60 and 63, you can do an extra 11,250. This is not both. You either get 8 or you get 11. It's not both if you're 60 to 63, but it is nice that you have that extra wiggle room. And then 403Bs, if you do have that as a, this would be maybe more if you're like an official, you could potentially have access to this. There is an additional catch up there as well with the years of service benefit to that. Other than that, on this piece, the main thing I would look at is your limit per participant here, this 72,000. This would be the most that one person can benefit in contributions to a solo 401k between what you do as an employee and what your company gives you in a profit sharing as well. So if you don't have a solo 401k, it's not relative to you, but if you do, just know that 72,000 is the most that can be put into the solo 401k for your individual benefit in 2026. And if you hit that limit and you still want to add more money, you can definitely reach out to me and we can talk about it further, but you can bring on a spouse and get even more contributions into the plan. Right here we have the simple IRA is another popular plan. This one is going to be 18,100 for you core reporters that have under 5 employees. So that's great. There's a catch-up contribution for this one as well. So quite a bit of wiggle room to be able to do the simple IRA. And then we have the SEP IRA, which is pretty standard, is the 25%. So nothing really changing much there. The only thing is this contribution limit number is the same. It's 72,000. This would really come into play if you're a sole proprietor. You would be able to do up to 25% of your income, maxing out at $72,000 per year. So it's there. It's probably, again, pretty hard to hit. You would have to be making over $288,000 a year and trying to max out this plan for it to become an issue. So we have a lot of wiggle room for this one as well. Lastly, for people who are doing things outside of their company plans and are doing personal plans as well, we have traditionals and Roth IRAs. And the contribution limit for this year, 7,500, you can put into that plan. Again, another catch-up contribution, which is great. And then there's Roth IRA eligibility, where you can only contribute to a Roth IRA if you make under these income brackets. So there's a phase out, which means at 153,000, you can still do the plan, but maybe not as much if you're in this window. And then when you hit 168 here, you can no longer do anything toward the Roth IRA. To keep it easy, I like to just think of it as like all or nothing. So I usually just reference this lower number of 153 just to make sure I don't do anything wrong. I'm either below 153 and I can do 7,500, or I'm over 153 and I can't do anything. So that's the way I would look at it, but a CPA can definitely run the calculation for you and see if you can do at least some type of contribution. So that's everything I wanted to go through in the guide today. I know it was kind of a lot and I went through it pretty quickly. So if you do have any specific questions, again, the best way to do it would be to leave a comment on this video. That way I can answer your question and others can learn from it as well. If you don't have this guide that I keep referencing, the important 2026 numbers guide, feel free to shoot me an email at brandon@traction-wealth.com and I'll be happy to send it over to you. And it really just lays all these different screenshots, I guess, that I took from it. And it just lays it all nice and you can print it out and just have a good reference for the year and make sure that it's nice and easy to follow as you progress through 2026. So let me know if you have any questions or anything, but otherwise, I hope you all have a great rest of your week and I'll see you all next time.